What's going on, everybody, and welcome back to your Financial Dose. Today we're going to be comparing mutual funds and ETFs and talking about which one you should be buying. So to start off, there are a lot of similarities between mutual funds and ETFs. For those who don't know, ETF stands for Exchange Traded Fund, and they represent a basket of stocks, or bonds in this case. Actually, recently now you're able to buy ETFs that combine stocks and bonds. On the other hand, you have mutual funds that represent the exact same thing. Also, a portfolio or a basket of stocks and or bonds that are meant to give you some sort of performance. Now let me explain this more in depth. So, depending on the type of mutual fund or ETF you will buy, they will have different purposes. Some ETFs or mutual funds will try to replicate certain indexes. Other mutual funds or ETFs will enable you to invest in large quantities of small cap companies or smaller sized companies that are publicly traded, while others will allow you to invest in companies that pay higher dividends. And the benefit of mutual funds and ETFs is that by buying only one instrument, so either one exchange traded fund or one mutual fund, that will give you exposure to hundreds and maybe even thousands of stocks, depending on the fund. And the benefit of this is achieving diversification. Because as you know, if you put all your eggs in one basket, for example, you put all the money you have in Apple, if Apple performs poorly over the next 10 years, but the stock market does very well, well, unfortunately, you're going to miss out on all those returns because all your eggs were in one basket and that basket did not perform well. Alternatively, if you buy, say, 20 or 30 individual stocks, yes, you are more diversified. But by opening 30 separate positions, every time that you buy a stock, you need to pay a commission. And every time you sell one, you need to pay a commission. At the same time, managing or looking after and following the news for 30 individual stocks can get overwhelming. So instead of going through the hassle of trying to select stocks on your own, ETFs and or mutual funds already group these stocks for you. And in some cases, these bonds. The reason why ETFs and mutual funds can either invest in stocks or bonds is that bonds have a lower risk and stocks have a higher risk. So if you're looking to invest in something far less risky, then the odds are that you're going to have a larger proportion of bonds within that fund. So now that we talked about the similarities between these two types of investments, let's talk about the differences. So first off, an ETF or exchange traded fund can be traded on the exchange. And what that means is that you can trade it just like you trade a stock. So if you want to buy it in the morning and sell it in the afternoon, that's okay and it's doable. On the other hand, mutual funds can only get traded once per day, and that's at the end of the day. So if you wake up in the morning and at 10:30 you want to buy a certain amount of units of your mutual fund, that transaction will only go through at the end of the day. So if that day the stock market went up 2% and you wanted to participate in that, unfortunately you missed the boat. The next thing I want to touch on is active management versus passive management. Now what passive management does is it looks at an index, so for example the S&P 500, and it tries to track it. What that means is it'll try to initiate the same positions or at least the same proportions so that if Apple represents 2% in the S&P 500, then Apple will also represent 2% in this S&P 500 index or mutual fund. So the passive approach can be found both in mutual funds and ETFs, and the benefit of this passive approach is that the fees are much less. Since you're not actively trying to beat the market, you're just trying to replicate a certain index. However, passive ETFs have an even lower fee compared to passive mutual funds just because they are a much lighter structure. On the other hand, we have actively managed funds. Now, actively managed funds pertain to mutual funds, and this is when you have a team that is headed by a portfolio manager, and what they will do is they will do research and they will try to actually beat the market. So although this may sound like a good strategy because you're actively trying to buy and sell stocks in order to beat the overall market, at the same time, there are much greater fees when you compare a passive mutual fund and an active mutual fund. Just as an example, I currently have a passive mutual fund that charges me about 0.3% per year. So what that means is if you invest $100 in this mutual fund, you will have to pay 30 cents per year no matter the performance. Now 30 cents isn't a lot of money, but if you have millions and millions of dollars compounded over many years, that can make a pretty big impact. And on average though, the average mutual fund MER, management expense ratio, which is another word for the management fee, is about 2.5%, which is extremely high when you compare it to some passively managed ETFs, which could have fees as low as 0.05%. Now, just as an example, what I did is I took an average return of 8% over 40 years, starting with $100,000 invested in either an ETF or a mutual fund. The only difference between these two funds is that the mutual fund has a 1.5% fee, which means that that 8% return now becomes 6.5% return. And let's see how these two portfolios grow over 40 years. So the ETF with the lower fee actually turns up $2.43 million after 40 years. The mutual fund, on the other hand, only generates $1.34 million over the 40 years. So the impact of a mere 1.5% compounded over the 40 years is over $1 million in this example. This just illustrates the importance of actually paying attention to your fee. Mutual funds also sometimes have a higher minimum investment required. So for example, if you want to buy one share of the ETF, well, you have some ETFs that trade at $20 and you have some ETFs that trade at $1,000. But by buying an ETF that trades at $20, your minimum investment is $20. But depending on the financial institution, you may need a minimum investment of $500 up to $3,000 depending on the type of mutual fund that you want to buy. Some funds will offer you a minimum of $100, but that's pretty rare. Also, what you need to keep in mind is there may be early redemption fees with mutual funds. What that means is that if you purchase a mutual fund today and you sell it tomorrow, you're going to be charged an additional fee to sell early. And this redemption fee is normally waived after, for example, 5 years. So if you purchase $100 worth of a mutual fund today, let it grow over 5 years, and then sell it in 5 years, you will no longer be charged that redemption fee. However, you will still be charged that management expense ratio that we were talking about earlier. Something else that's interesting is that since an exchange-traded fund is traded on the exchange, you can actually sell it short, which means instead of buying it, meaning that you're betting that it's going to go up, you can actually sell it, which means that you're betting that it will go down. There's no such possible transaction that you can do with a mutual fund. And finally, the last main difference is that since mutual funds are normally actively traded, or since you can invest in mutual funds that are actively traded, the active trading will trigger a taxable event. And what that means is that if the mutual fund itself generates a profit, so if it buys a stock at $10 and sells it at $15, these $5 of capital gains will then be added to your income and taxed. Or sorry, half of the capital gains, depending on where you are located in the world. There's different rules when it comes to taxable capital gains. However, the point is that the capital gain that you will generate in this mutual fund, part of it will be taxed at the personal level. Another example is if you want to sell $50,000 of that mutual fund so you can take the cash and put it in your pocket, if the fund has to actually physically sell positions so that they can give you your money, that will also trigger a taxable event for everyone. An ETF, on the other hand, while yes, it can trigger taxable events when the ETF may rebalance the positions, since they're not actively traded, much less capital gains are created compared to the mutual fund. Now the question comes down to, well, what should you buy and what offers the better performance? Now, the benefits of a mutual fund is that they're very easily accessible. If you go into your retail bank and you sit down with an advisor, he could have you invested in mutual funds within days, and there's nothing for you really to do than to sign a few papers. On the other hand, for an ETF, you need to actually be able to buy them yourself. So you need to open an online brokerage account or a brokerage account through your bank. Nonetheless, it takes more effort to actually buy your first ETF. However, since there are higher fees, do higher fees actually correlate to a higher performance? If you have a team that are actively managing the portfolio or the fund, wouldn't that mean that you should generate more money or a greater return compared to a passive ETF? Well, what studies show is that over short periods of time, mutual funds can outperform the passive ETFs, or mutual funds can outperform passive mutual funds. However, over extended period of times, like 10 years, it is very rare that you will find an actively managed mutual fund outperform a passively managed ETF or mutual fund. So that really begs the question, what's the point? Why would someone want to invest their money in a mutual fund that charges a higher fee when they could get similar or even better performance from a fund that is passively managed and charges a much lower fee? Now, in most cases, you should not be putting your money in these higher cost mutual funds because the fees will eat away at your returns in a tremendous way. However, if there's a specific mutual fund that fits the strategy that you believe in and that you want to execute, for example, a mutual fund that actively trades in the biotech space, and you think that this fund manager is really good, and you think that the biotech space is going to do really well as well, well then of course you can purchase that mutual fund and pay the higher fee. And maybe it'll be worth it in the short term, or maybe even in the long run you'll be able to beat the index. However, in most cases, it's much better to purchase either a passively managed mutual fund if you don't want to go through the hassle of opening up your own brokerage account and managing it yourself, or if you're a little more adventurous, open up your online brokerage account and try and purchase a few ETFs and let us know how it goes. And I think that ETFs are really the cornerstone to any complete investment portfolio. Whether or not you're beginning or where you're a seasoned investor, there's always room for an ETF in your portfolio. Anyways, guys, thanks for tuning in. I hope you learned something. As usual, if you have any questions or comments, please leave them below. It will make me more than happy to review them, and I will see you in the next video.